Hey, good morning. Good afternoon. How's everyone doing? All okay. So I see Alfred, uh, Dustin, Janice, Jose, Juan, Matt, Pushkin, Rose. I think all are familiar names. So guys, what's up? How's been the week? Markets haven't done much. I think for the whole year they haven't done much anyway. Jose says amazing. Jose, you've been commodities and also into energy and oil and all that stuff. That would have been a good week for you anyway.
No, I didn't. I got out of oil after the Venezuela thing, so I missed out that on that boat on that train.
Oh, is it?
Yeah. No, I mean my portfolio is doing all right. Nothing crazy.
Yeah, I mean, if even if you are positive on portfolio, that's a great thing to have. Markets, I mean, I think if we look at a spice, I mean, markets are doing okay, not too bad.
Well, I was gonna say, do you watch All In podcast? You watch it,
I
son.
I used to watch regularly, but
Yeah.
then I stopped watching it because it became too political. But the
Well,
recent
that's
one I watched,
yeah. So
the
I
one
don't
with the
know.
Brad Gerstner.
Yeah, exactly. So I just watched that, and they're obvious for that exact reason, right? They have inside track into the administration, and they all seem pretty confident that it's going to end pretty soon. And
These
even
the Yeah, so I mean prior to election, I mean these guys were are very strong supporter of the current
yeah,
president,
yeah, because I have a
except
guy.
I think the Jason, all other
Yes.
were very strong supporters. So I guess they'll need lot of they'll take a lot of time to change their opinion. So I'm not gonna take them on face value.
Well, yeah, but I mean, that's the same reason why I think their opinion is valuable in this case, right? Because they have a guy inside,
Correct.
and even like Chamath, his line of thinking was like similar to what I've been thinking, and just in terms of like the timeline and like how they have a meeting with Xi in 2 weeks. You know what I
Yeah.
mean? So it's like
Yeah.
it kind of I just thought that was interesting because like I haven't listened to it in a while, and they said exactly what I thought.
Right. Right. But I saw the Friedberg guy was not there yesterday for whatever reason. He was one of our sane voices, focused specifically on science and used to stay away from politics. And he's not there on the podcast.
Yeah,
At least
well,
wasn't there on the recent episode. I don't know if he has been in the previous ones.
you can't stay away from politics when there's a war in Iran, right?
Yeah, I stopped watching them because it became too political. All right, Alfred is saying stuck in Philippines. He'll be back in Bay Area in 10 days. Yeah, well, hope to see you there. Dustin, for the first time, Dustin, what brings you here? And how did you find us? And what kind of an investor are you?
I'm a beginner, just getting started, wanting to learn a little bit about
Hmm.
market and trading and things like that.
Okay. Right. Beginner means they've already done some investments, ETF stocks, or is like
No, no, very
okay,
little experience. I've done some very amateur trading in cryptocurrency, but that's about it.
okay. All right, you started on the deep end of the pool.
I hope I'm in the right place.
All right, so we have a folks that I mean I'm mostly a investor, but I do trade options, so stay in the game. We have folks who are also more into trading, swing or day trading. But yeah, so hang around. You'll probably might pick up some information that you may find useful. All right, what else? So uh, let me share my screen and let's get started. How do I get rid of 1 second? I'm looking. My screen seems. All right, yeah, now it's back. Okay, anyone bought anything new or anything, tried anything new in the either in the markets or otherwise? What's the new learnings for this week? Nothing, just hanging around, seeing, taking as it comes.
I guess oil's supposed to be the hotness, but it probably already broke out, huh?
Yeah, my perspective, if you have not been in oil or, earlier when it was around 65, probably it's too late to now learn about the oil industry and try to get in. Uh, it's already, I mean, we had a wild swing on oil, right? From 90 to 120 and then back to 1996 somewhere. I'm not big on commodities. I don't understand the space that well. So I just have an ETF for energy, not just oil, but I have an XLE. That's the ETF for my exposure. I don't think I want to chase the rally. Um, my thought process is just that, hey, if it ends soon, markets will react positively and oil will come down, and if it gets prolonged, market will adjust is anyway, right? So I'm not trying to take any drastic decisions in terms of a portfolio, because it's a matter of time. We have seen many of these conflicts, geopolitical conflicts, macro shocks. um, it lasts for maybe a few weeks to a few months. Ukraine is still going on even after 4 years, but then market have adjusted. Jose says sold put on copper stock and gold stock. Oh, copper fell. I have no idea. I don't even look at, I never looked at copper. But what about the GLD? What did gold do? Gold has been range bound for the past few weeks, so nothing much of a, I would say, change. What else? Anything? Any other stuff? I tried a few things this week. I'll share that. So we got 10 minutes over the hour. Let's get started. Anyone else here joining for the first time?
Yeah,
And
it's my first time.
oh, Brian, so yeah, so do let us know what kind of investor you are and what are you looking to get out of this.
Um, I'd say beginner to Wall Street bet style investor. I held on too long after 2020, which was sad. But and yeah, I lost a bit trying to play options, but I realized, theta decay now, and even though it's trading sideways, you can get blasted from the IV. Um,
Yeah.
yeah, now I'm just holding on to just some index funds like SOXX, BOTZ, the AI, the robotic stuff. Um, yeah, I wish I bought more silver last year, but whatever.
Yep.
Uh, so yeah, it's
All
just
right, you're not the only one. Everyone has paid tuition to the market. So as long as figure out how to stay alive, the markets anyway has an upward tailwind because economy continue to grow. We just trying to figure out not to get washed out from the market.
for sure. What trading system you have up here? What broker is it?
Oh, this is Thinkorswim.
Okay.
This is Thinkorswim. I mean, if you're a serious about using options, I don't think there's a better platform than Thinkorswim. Tastyworks is another one. I had tried Robinhood, but that was like a couple of years ago. It didn't even have all the information that I needed to make a decision on trade. Then I didn't, I never used Robinhood after that. But I know they have updated their system in last 2 years. They become much better. But
I
so I've
do
been stuck with Thinkorswim for past almost 9 years.
I do softwares, and I just recently signed up for Interactive Brokers so I
Mhm.
can play with their API.
Yeah. Okay. Yeah. So I think Interactive Brokers is also good. You can also trade international stocks very easily on international exchanges using Interactive Brokers.
Oh, that's good to know. Maybe try to do some arbitrage.
Yeah. I don't do that. Yeah. If that's your thing, go ahead. All right. Fertilizer stocks. James, give me some takers on fertilizer stocks. That's the area that we never talked about. I don't think in last 6 years, ever since we have these meetings, we ever discussed fertilizer stocks. Maybe once in a while we talk about potash, but not particular stock. SQM, Chile, a Chilean company. Did I get this right? SQM? Yeah, not bad. But this is an area that I've never explored, fertilizer stocks. So what's your thesis, James? What do you think? What suddenly got you interested in fertilizer stocks? Was it that okay? The stock price has done pretty nice. Or last 1 year is up 80%. Okay. Potassium nitrate, yes. Oh, it impact fertilizer. Okay, high oil prices. Right. So that would, I don't know, maybe it would be negative for fertilizer stocks, or the other way around, could they just pass on the cost to their customers? JW, where can we get this meeting's recording? Okay, okay, I'll show you in a minute. Short jets. Yeah, higher fuel prices is not good for airlines. But then you can also take a contrarian bet saying, gosh, this have already beaten up too much. And if we get a resolution to the conflict, this should revert back. I'm not a huge, you guys know, I'm not a big fan of owning airline businesses for the long term, but something from a swing perspective, right? Depending on, if this is your thing. Right now it's below all the averages, and I know someone would say wait for it to cross 200 moving average, then you take a position. But right now it's been beaten down like hell. And if we get some resolution, these jets should come back up. I do have, I think, short put on jets, hoping for the resolution, but won't be holding it for a long term, because I don't think airlines me personally don't would want to hold airlines as a part of my core portfolio. All right, so let's get started, guys. Discussion number 315. We are on March 14th, almost 6 years. So thank you for showing up every weekend where we can talk about stocks and what's happening on the markets, investments, fixed income, crypto, IPOs, etc., etc., etc. All right. So first, a quick update. One is last week I talked about 13F analysis and how I added an ability for you guys to go and look at what the fund managers are doing. I added a few more fund managers to it. So now I think I have total of 99 fund managers data in this, and on top of it I also added yeah, so let me just look at you can see, yeah, 99 fund managers data right now, and I also added a few additional themes so that you can go and look at it. For example, allocation to chip stocks, right? Allocation to e-commerce companies, allocation to Chinese companies. I'll just give a couple of examples, and you can look at those. Uh, or you can look at how the fund manager is allocating capital to the stocks that you want to own. Let's say, I don't know, pick up a stock, some stock very popular among retail investor is, one of them is like Palantir, right? So, but not out of 99 fund managers data that I have from 13F filings, there's only one that has invested like 400K in Palantir, right? So fund managers are not keen on Palantir, whereas a lot of retail investors are. Anyway, so you can play around with your own stocks and see how those who manage money for their business, how are they interested in your stock or not. And then, like I said, there are various themes. You can look at the data collectively. This is what theme is it? This is chip companies. So basically, I have ADI, AMAT, AMD, ARM, so on and so forth. You can look around and see, what collectively what the fund managers are doing. Chinese companies, fintech companies, etc., etc. Okay, so one is I wanted to share this information with you, quick update. And someone asked where you can get the meetings recording. So I do post the recordings on my website. I'll update it through the meetup when the recording is up, so you can go and look at the recordings of all over here. So recording will be here. Okay, sounds good. Any other question? I hope to add some more information now. I'm getting some little bit more time to add more data or some information that could be more useful. For example, maybe posting the details around the deep dives on stocks, etc. I've done it multiple times in these sessions, but I've never been found enough time to update it on the site. The fund manager data update every week. No, so it's based on 13F data. So if you look at does says right, it's 13F analysis. Each of the money managers who manage more than $100 million have to file a couple of documents with SEC. One is 13F, one is ADV form. 13F is closely watched by Wall Street's and all the investing community, which tells you where they've allocated capital. So it includes US equities, certain options, convertible bonds, ETF, ADS. It does not talk about futures, commodities, etc. And the timeline, the deadline, SEC deadline for filing this form is 45 days after the end of quarter. That's why, you will start seeing 13F coming out around month 30 days after the quarter, and the deadline is 45 days after the end of a quarter. So this information is currently as of end of December 2025. Right? After that, positions could have changed, but it'll tell you something about, hey, I'm specifically interested to know in terms of when the Wall Street guys come and talk about in the media, and then I go and see what are their filing indicate, right? Are they putting their money where their mouth is? And many times I've been surprised that they'll talk about a company very highly, but then you realize that they actually sold off a positions in the previous quarter. So, it's something to know. I don't think I'm gonna base all my decision based on what the fund managers are doing, but it's good to know in terms of, hey, who is doing what, um, from if especially if I'm interested in some of the particular stocks that I own, right? So let's say I want to look at a Uber, and so I don't know who has exited Uber, who have added positions, who have reduced their positions, right? Stuff like that. Jose saying Bitcoin started to pick up, stand bullish for overall market. If you have short-term volumes specs. Yeah, I did see Bitcoin is what now 70 plus, but it's been like pretty range bound over the last few months. So I kind of became immune to where where it goes. Ever since what some Feb side, we have been like around 70.
It's a good leading indicator. You know what I mean? Because it's risk on.
It is still risk on, right? So now little bit of a, I would say, thesis has changed. The whole idea of Bitcoin would become,
Yeah, it's not a flight to safety.
yeah, it's not like say, yeah, it was supposed to be flight to safety when there is a global concern,
I
right?
I think I was watching something and they made a really good point. They said that if we ever get a hack of the financial system by a country like Iran or like North Korea, then Bitcoin will become a flight to safety. But until then, it's just risk on.
Yeah, I don't know if a financial system, yeah, we'll have to see. The other way to talk about could be, hey, anything which is on online could become vulnerable, and then maybe people will switch to a physical material or like physical gold, etc.
Yeah, but if they just hacked the banks and then left the
Yeah.
rest of the none of
By the way, I think there was a news today morning that Iran had maybe it's a old news, maybe yesterday, that Iran has allowed um, for ships to pass through Strait of Hormuz as long as the the deal is in yuan. So it's already kind of trying to
so it's about
uh,
China. This is all about China.
yeah, move away from trying to basically challenge the dollar denomination on oil trade. We'll see how that pans out. Anyway, so firstly, I want to give you a quick update on a few more stuff that I added on Thinkorswim. Other thing I want to talk about, where are Thinkorswim experts, TOS experts? How many people out here use Thinkorswim? I know, Fred, you are a TOS expert. Who else? Also, you have TOS, right?
No, I do Fidelity.
Oh, you use Fidelity. Not many TOS users out here?
I use Toss.
Okay, Aditya says toss. So I was surprised that I can't even on toss mobile or on your iPad, you could actually see your daily change percent, right? So if you get up, you're looking at your portfolio at 11 a.m. or whatever time while the market is open, you would know exactly what percent your portfolio is up or down. But on the desktop, you don't see it. And I was like, this is such a basic information. So I called up the support people. I was chatting with them, and they say, "You, the dollar value is there, but the percent is not there." And I was like, "What? This is no way to get it." I thought maybe I'll ask here. Maybe Fred, you might know a way to get it. The percent. Why that should be so hard? It's on their mobile app, it's on their iPad app, but it's not there on desktop. I never realized it until I really wanted to use it. I can see the dollar value, but I can't see, like, is it down 1% up, or whatever the percent change is not available. So if any one of you have figured it out, or if you say, do let us know. Or if you're someone of you have created a custom study that shows your current daily percent change. Um, then, Aditya, I assume you already tried creating a custom field. I did, not a field, but I did try to create a custom label which shows the daily percent, but then it doesn't refresh, right, automatically. So, and then it depends on the aggregation. It changes. It's not really working it out. So I was chatting with on the Thinkorswim. If you use, there is a chat room available, various chat rooms available. So I did post my script onto one of the chats. Another person gave me their script. We're still not working. It is still not giving the right information. The one which I have is, if you go to that chart tab where you have that label, it'll show you what's your current daily changes. But it does, like I would want it to update, like say every 30 seconds or every minute. It doesn't. Many new features added it also in last 2 years. I think there is a need to look out there. But thanks, right? Yeah. And I was surprised. I thought maybe I'm missing something. That's why I reached out to support. I'm like, hey, this basic information you already have on other form factors. I just don't see on a desktop. I can't figure out how to get it on the desktop. But then they realize they don't even have it. All right. What else? Something new. I actually spent bought a Claude subscription this week. Now to me, looks like this subscription. I have a Gemini and I bought Claude. Looks like this is going to be like a streaming like subscription, right? You got a Disney, you got Netflix, you got Amazon Prime, and whatnot. So seems to be becoming a similar pattern for these AI tools. But I was blown away by Claude. And it's a capability, especially around trying to a coding side. Again, I'm not a software engineer, but I being in the tech spent 2 decades in tech industry, so I would say I'm a tech aware, but I'm not a software engineer. And I was super excited that it allowed me to build some stuff that I've been having on the back of my mind for last almost 2 years. I thought one day I'll try this, and I did try it on this week and got started on it. It was amazing. I was so super excited. I think that after many years, I actually pulled a full nighter. So I started working on it around like say 12:30 or around, yeah, after I got my kid from the lab. Yeah, it's around midnight I started working, and I worked all through till 7:30 a.m. So super excited. I'm like,
Wow. The tokens lasted unless you got a
no,
max.
at around 7 o'clock it says, okay, no more discussion on this one. And then I realized how stupid I was. I should have. And this is a part of learning, right? That you should start small, ask small questions. I was trying to get all the error fixed for even things that are not that important. I didn't realize, but now I know. Now I figured, okay, next chat, at least I'll ask them. I ask them to get the general setup right before I start to deep down and say, okay, fix this, fix that. But it was amazing. Uh,
Yeah, yeah.
Like
Vivek,
I said, after many years, I pulled a whole nighter.
Well, that
Earlier, I
says
used to pull
something.
whole
Yeah,
nighter because my job demanded it. This time, I did it because I myself was interested in it.
that's incredible. The lower models have a lower rate of token utilization, so in case there are simpler problems, they can solve for you. And then, so Sonnet uses less, and Opus
So
for
I'm
uses
actually,
more.
I'm not even using a Claude code. I'm still on the chat. I can't
Right,
even imagine if you use a code, Claude code, how powerful would it be?
right. Yeah,
And, and no surprises why we are seeing um, you know the layoffs or non-hiring of lower level or junior roles in many such industries, especially the software development industry. It's been completely changed. I mean, I could just feel it. I'm like,
yep.
wow, it has allowed a person like me to add another section onto my own website. It's integrated. I told them this is the setup that I have, and it you know figured it out. It gave me integrated everything in my current setup. It's not that it's on my local, it's on my current website. I say I want to make these additions to it, and it'll help me through. It's amazing. Anyway, now I have to find another day on which I can pull another all-nighter to to add to it. But that was an amazing learning for me.
Vivek, so usually that is the journey people go through. Like when you start using these tools early on, you feel the euphoria about it. And there is at certain mark you will feel like if you use the Claude code, you can actually plan the project ahead so that you don't need to do this much setting. And then you can say at the end, just build it. That is much more efficient because then it will figure out all the problem which will need to happen.
Yeah, I
So
guess. Yeah. No, I
try
agree
the
with you.
agent also. So what you can do is this is generally I do is basically you create multiple agents and then you define those agents the responsibilities. That one agent is just writing the code, other one is just verifying it and then designing it and all of those things. So it's kind of a teamwork, but that gives you a clean plan to execute
Yeah.
rather than spending too much token on writing code.
Yeah, and I have seen some videos where this is what exactly it is what you said. It's like
Mm.
they give instructions that then sit back and see
Yeah,
computer do the stuff for you. I was just so excited the moment to get subscription. It's like on I think it was on Thursday is when I just enabled my subscription and I just got super excited by it. But yeah, I'll
and
have to look into and maybe go through some YouTube videos to see how to use a Claude code and do it the right way.
yeah,
But tell me, I don't think I've been. I think after it was like a similar excitement the way when I had first access the internet, and I'm like, wow. I can just type something and it'll bring me information from from all over the world. I had a similar feeling.
And Vivek, by just one final add-on, and you can also get, so just as Nitesh was saying, you can also get it to write the description for the agents, which then do their coding. So yeah, so
Yeah, I haven't even gone to agent yet. Like I said, I was just on the chat,
right.
and that itself was so powerful. I can't imagine what the other stuff will do. So world is about to change. We are seeing in the markets. That's why we are seeing all the SaaS companies and what's happened with the SaaS companies, and sure, why not,
Yeah.
right?
So it really
Vivek,
might not be overblown, the correction we're seeing. It really might not be.
I
Yeah.
would say hold on your thought for maybe 2 months and then reevaluate your thought process because it will evolve also. Like you are seeing the initial euphoria, but this is what I have faced it after a couple of months. It changed. I'll ask you the same question maybe 2 months later.
Yeah.
How do you feel?
So here's my assessment of this. It's great to do a POC or to have a software on which you can, maybe fewer users using it if it is a multi-user software. But I don't think it's there at where you can build or you can just deploy it in production directly. Still we need to have humans review it before we can push it out to production or put our mission critical stuff or in the regulated industries, because at the end of the day still hallucinate, it's not deterministic. And when an industry is like healthcare or financials where you need a deterministic answer that this is what's going to be always, AI is not there yet. But maybe, maybe the things are changing so fast that maybe 6 months later things could change. Right? Anyway, Fred, is you given me a percent daily change, but this is I think at a ticker level. I want at a portfolio level. At a ticker level, I know percent change at a daily, but I want it at a portfolio level, not at an individual ticker level. All right, what else? Um, housekeeping stuff. Maybe we'll skip the conviction and concentration topic for the next week. A couple of things on housekeeping. One is next week I'm on a parental duty, so no session next week. I've been avoiding it for I would say last 3 years, ever since my daughter got into her school team, and but now she says this is the last year, so dad, you have to go and do this. So no session on 21st of March. I won't be able to host it. I'll engage some for my some of the kids' school event. Second thing is today in another 30 minutes, I have to step out for 15 minutes. Some college results are coming up, and I think the college that my daughter is most interested to go, they are announcing results at 11 o'clock PST. So I think me and my wife will be with her to see, what happens. So I'll step out for 15 minutes at in another 25 minutes. All right, and then we'll come back and continue. But maybe I'll leave the breakout rooms open. So if you guys want to go and talk about different stuff, go ahead. Right. All right, so let's see what did I on the macro side. We talked about it. What did I notice this week is um, oil have been very volatile, like say $90 to $120, then back to 90 after IAE, the whatever international IEA energy agency, they basically all got together and say we're gonna release 400 million barrels of oil from the member countries. I thought the oil price would come down, but it did not. I spent $4.80 at Costco. That was the price at Costco. What on Wednesday? So it's and this is California Costco. So in other states it's going to be cheaper because our state taxes the oil heavily, which is and it's probably one of the most expensive state for oil. The other thing to notice was US has authorized temporary purchase or sanction Russian oil. Again, at the end of the day, we're trying to figure out how to avoid the big disruption in the world market for oil, and because this is the prime source of energy, and if the cost of energy goes high, there's a direct impact on your gas, but then there is a lot of indirect impact on all other economic activities because they all need energy. But we'll see. Um, we thought that these things will be over in a week or two. Doesn't look to be, right? So this could continue for longer, and it might be a while before we can get back to $65 barrel. And until then, the market could continue to be choppy and maybe sideways, which I love. Market moving sideways, you can continue to sell enough of a premium and then just sit around and just eat theta. I mean, these are the best things. I would say staying sideways. It help you mentally, and also you can all the premium that you sold just comes back, you know, basically expires worthless. But we'll see. We'll see. Right now, we're anticipating rise in inflation, and that caused another concern. If you look at this chart from S&P and FactSet, right, WTI crude oil price has gone up, and we're expecting that inflation. I think we had a PCE number or CPI number came out, which was in line, but maybe the next number might see an uptick in inflation, and then that gets into the all other discussion of rate cuts and all other stuff. We were expecting two rate cuts, two or three rate cuts. Maybe we'll just get one, or maybe none. I think some of the central bankers, they in fact are raising rates. Right? So even if we get one, I think we should be happy about it. It all depends on what the inflation number comes out. And then this week we had another wrench thrown in the on the whole Fed side was one of a federal judge. They blocked subpoenas that were issued against Fed chair. So this drama will continue for long. This is how, as we get know, this is like also politically motivated drama, at least at the surface level, and that's what the judge also mentioned. We know President has been pressurizing Powell to reduce the rate, which he has defied, and based on the reason that inflation is still not under control. But because this drama is gonna continue, then the confirmation for the incoming Fed chair Kevin Walsh will get delayed because I guess one of lawmaker Tillis has put his foot down saying until this is resolved, he's not going to vote for any of the Fed nominees, which is now we have only one, which is Kevin Walsh. So he was supposed to be, market was expecting once Kevin Walsh come in, he'll reduce the rates and all that stuff. Now a little bit of uncertainty around that. So I guess that's what on Friday we saw little more volatility in markets. It sold off after the judgment came out, and we'll see what happens. FOMC meeting is in this week, on generally on Wednesday. The meeting is on Tuesdays and Wednesday, and then Wednesday Chair Powell will come and basically address the press, and not expecting anything this week. I mean, anyway, his term ends in May, and but I don't know what does anyone know what if we don't have a new Fed chair confirmation? What happens to the position? Does Jerome Powell continue as a governor, or the position stay vacated? I doubt if it stays vacated. I don't know. But that's a uncertainty, and markets did sell off after that news. But we'll see. Like I said earlier, right? These things will settle down, and um, in the long term, really doesn't matter. But on day-to-day basis, if you're looking at the markets on day-to-day basis, yes, then depending on what the latest news is, markets will go either move up or down. All right. So I was looking at the probabilities. Sorry guys, I still look at this table and not at poly market or Kalshi. Maybe I need to change to start looking at poly market and what the bets are there. But currently on a Fed watch tool, we're only looking at one cut. That's also not 50% probability. So the, I don't know. This looks to be like there is maybe somewhere in December we have the highest probability. That's also not 50% that we might get one cut. Right? So it means all the what you call growthier part of our markets, especially some of the tech companies or companies in Russell 2000 that need lower rates, they will still stay challenged if we don't get a rate cut. But looking at a bigger picture, this is the world over global economic activity has been pretty healthy in recent. I don't let's say forget about what's happened in last 1-2 months. If your economic activity continues to stay high, and in the previous sessions we talked about earnings growth of S&P 500, they all still look healthy even for the upcoming 2026. We are still projecting 12 to 14% earnings growth, right? Still in a pretty healthy space. So I'll just focus on that and make sure at least for next 1 year I don't need any income from the stock market. We'll still do fine. So that's at a very high global level. Looking at a fear and greed index, now we're in extreme fear. This is maybe this is a time to start loosening out a little bit of a purse and start buying the stuff. This is where I want to. This is where I want to go and buy. I think during the Liberation Week, we had a single digits. This fear and greed index was in single digits. I don't think I've seen this after that. But yeah, this is a time to shop. If you are interested or looking to deploy capital, uh, this is a better time to deploy than I would say anytime this year, because it's the first time I'm seeing in an extreme fear market. Uh, Johnson, has any thought on BlackRock limiting withdrawals? So we will talk about when I talk about a sector comparison, and maybe I think that could be the next one. So crypto was a little better, and I think Jose mentioned already reasons why it is. So let's look at a sector level. Looking at sector level, looking at the financials is the worst, like negative 11%. Whereas to start with, I thought the financials will do good this year, assuming the market will return back to the IPO will be happening and the M&A will be happening, and we get a couple of rate cuts, which is good for financials because it will create uptick in loan activities, which is how the financials make money. And the reality, at least in whatever 2 month plus 1 week, has been completely opposite. Financials have been the sector has been beaten up the worst, and the energy has been on the top. Energy is up almost 28%, right? I don't think any surprise is there, but financials really was a surprise, and it is because of what we are seeing in the private capital, right? Sometimes last year all these big money managers have been trying to lure, I would, or hook retail investors into private capital, right? Private credit or private equity. I would rather combine them and call it as a private capital, and that hasn't been done doing any, that hasn't been performing well. I would say there have been last year there were some bankruptcies happened under the private credit. We continue to see some of the funds that are restricting withdrawals and the redemptions from it. One of them latest came as a BlackRock. Right? So BlackRock, they are facing a rush of exits by existing clients. They spent $12 billion in buying HPS investment partners, and now their clients, they want to get out of those funds, and then they had to put a they also put a limit on withdrawals from their on one another fund. So there is a and it's not just BlackRock. Earlier we had seen Blue Owl Capital, and it shows up in their stock prices, right? The market has not let me you bet they have punished some of these stocks because of all the issues that we are seeing around private credit. Let me see if I don't have a, a watch list or where I have all private credit. Strange. Maybe we should build one, which is around all private credit slash private equity stuff. I thought I did, but no. But anyway, so the BlackRock stock was punished, and not just BlackRock. We had Blue Owl Capital. They got punished because they also had they suspended the redemption from one of their funds. Blackstone, a big market in on the private credit side, they had either raised the limits or backstop them. Again, Blue Owl, another one. I just asked Gemini to give me the list of the funds. Ares, big player. Now the most recent one, I think this week, was Cliffwater. So if you recall, Jamie Dimon had talked about after the bankruptcy of which company was that? Some brands, right? There were two companies that were bankrupt last year, and that exposed their bankruptcy. Basically, exposed that how many of the private credit institutions they lost money in that bankruptcy. And then Jamie Dimon in one of an interview had said that there is never one single cockroach in your closets, right? So now we are seeing a few more cockroaches coming out, and that has dragged down all the financial sector. And the reason why is, BlackRock and some of these big investment firms, Wall Street firms, have been pushing uh, the administration to, and I think Trump already did an executive order around it to allow these private credit, private equity issuers to become part of 401k. Because if you become a part of 401k, then this like every other week, right, every fortnight, there's the money going in this anyway, and they're gonna reap in a lot of fees. So that's the one reason why they want all the 401ks to be exposed and be allowed to invest in private credit, because their existing customers are running for the door, and they need new money to continue earn fee and basically save their funds from liquidation. Sorry, I've been very, very critical of this or the whatever ever since we started seeing the winds around. Let's give the small guys access to this, right? Let's democratize this. Come on, you know um, don't give me this shit around that you are actually thinking about retail investors, right? They're just not finding enough capital to raise from their existing customers, like pension funds, because they were already nose deep into private credit stuff. They said, no more, no more for you guys. And that's where they started figuring out how to get retail investors sucked into this thing. Anyway, you do your own due diligence. I have nothing to, I'm not gonna touch these things from a 10-foot pole. You never know what kind of assets have been involved in it. And I've seen reports around the way, and this gives me feeling of our 2008 financial crisis where there is the due diligence have been thrown out of a door. There were articles maybe 2 years ago in Wall Street Journal or in FT, I can't recall, around how a small firm in a multi-story house somewhere in one states or northeast, now I can't even recall, they basically reviewed, they're like reviewing hundreds of private credit these projects and assigning them ratings just like rating agencies did during the mortgage crisis. It's like a with the skeleton staff, you how can you ever do a good job of analyzing these projects and give them, investment grade ratings? Like, gosh, so I've been very critical of these things. I'm not gonna, I'm gonna stay out. Yeah, go ahead, Nitesh. You have a question?
Yeah, so the marker, the ticket marker you just said, is it correct? The Aries Strategic Income Corp, is it the actual marker or their fund name, like the stock?
This is their fund, so I don't know if this like actually traded or
Okay.
on in the like stock market or not.
I know Blackstone and BlackRock's are, but I'm not sure about
Oh,
others.
Aries is a big player in private credit. So Aries, Blue Owl, etc. They also help other companies in raising funds. So there are, and now we also saw. So what happened was after 2008, ever since banks were kind of restricted from playing in this private credit market, a lot of private equity firms started to get in, right? So Aries and Blue Owl have been there around for some time, but the things like you see KKR, right, Carlyle, they were like, dude, why don't we get in? Because there's a high fee in this. It's a fat fee to be made in this market, right? And since the banks were, more regulations were added after the financial crisis, they all moved into this space.
I know KKR and others are making a lot of money on this, but I'm hearing some of these names for first time.
Oh, okay. So yeah, again, I think again we talked about it earlier also. Every crisis, there is a new reason that we figure out. Hey, this crisis happened because of this. Like in 2008, we figured out it was a mortgage, and then regulators tightened the rules around mortgage so that we don't give approved mortgage for someone who has zero income or no stated income, right? You can't get this that that mortgages anymore. But maybe somehow I have a feeling that the upheaval that we may see in the financial market will probably come from a private credit side. Because even though the banks are not lending them direct, not lending to the borrower directly, a lot of banks are lending money to these companies, Blue Owl, Blackstone, BlackRock. But this is an indirect exposure to the private credit segment, which we have not been the regulators have not been closely monitoring, because they're looking at, yeah, your balance sheet, you're lending it to the big companies, not lending it to small businesses who are not credit worthy. Blackstone is credit worthy, BlackRocks are big guys, but what happens when the companies that they have lent it to, right, start going bankrupt, like we saw two last year. There was another bankruptcy that happened in UK, and some big private credit issuer had gone belly up over there also. So I don't know, dude. I have a very skeptical view of this whole fucking private credit stuff and how they've been trying to get retail investors sucked into this. But anyway, so that's what been dragging down financials.
I see the tie of Sasecar to here because a lot of private credit companies own SaaS softwares which
Yes.
are going to go away. because some of those products are better built in the public market, or startups are taking over some of those things.
So
And
it's been uh, pretty amazing to see that some of these private credit companies got hit by their own actions. What I mean is, like you rightly said, many of the SaaS companies have raised funds or debts from these private credit companies. So they have exposure to many of the SaaS companies. And now, with an all AI stuff and the money that we need for all the capex, many of these private credit companies have exposed and have these companies, right? Blue Owl was working with Meta for their capex and raising billions of dollars. So they have exposure there. So so basically, they end up in shooting themselves in the foot in terms of a lot of these private credit companies gave a push and got investments into the AI, which is then going to disrupt the whole SaaS on which they had already invested in. Right. So that was like a big, a little bit funny loop, and no, but they didn't realize that the AI projects that they are funding is going to upend the investments that they already have in the SaaS companies. It was only in hindsight then that they're like, oh, come on, we've been funding all these data centers, and that's gonna make all the SaaS companies, I wouldn't say obsolete, but they're gonna put a lot of pricing power and margin, pricing pressure and margin pressure on the SaaS companies, and they have a lot of exposure on the SaaS companies anyway. But that was a, I think that's where a lot of these the private equity companies have been caught. But we'll see how that happens. How eventually things will work out, but for now, staying away from all these funds, all this private credit stuff. Anyone knows the Goldman Sachs? I don't know. Silicon Valley Bank. No, no. So that's why I'm not picking any individual companies. For me, I'll maybe stay with the biggest ones, right? With all the financials being punished. If you look at XLF, right? We are down what 11% for the year. Financials are back where they were last in during the liberation week, right? If you want, and if you understand banking, again, it's very difficult to look at the books of these banks and try to make sense out of it. So I don't own any individual banks, but maybe some of the bigger one, more established ones like JP Morgan's and the Bank of America's. You may want to look at that and say, hey, they took a hit because of all this private credit was. Maybe you want to take an exposure if you want financials exposure. For me, I'll just stick with XLR because I mean, this is not a way for me to go and analyze what the bank's exposures are. Pranav says, what is private equity funds? Please elaborate. Okay, I'll do that and then I'll step away for 10-15 minutes. So if you are a company who's, a need loans, but then your company you don't have a good credit or you're not an established company, then the regular banks won't give you a loan. So what do? You approach these like Aries and the Blue Owl Capitals, etc. Or if the project is like a little bit a risky project, you don't know what can't foresee the returns, etc. You reach out to these private lenders who will then give you loans. So that's what it's called, private credit. Uh, that and then the banks won't fund these projects, but some of these companies will fund it. Also, Anar has given a link to a Barron's article, why it could be a bigger problem than Iran war. Yeah, I mean, okay, maybe I'll go through this, but I'm a little skeptical that maybe the next domino that's gonna fall could be a private credit domino. Quick look into S&P 500 movers and shakers, the worst weekly performances. FICO was down 21% just for the week. What ailed FICO? Did they have results? You see, oh, Jesus, no results. Is it the same stuff around Claude that is going to get disrupted? What the heck? What happened to FICO especially? I mean, it have had I remember having a few drawdowns, and then there was some.
This is the credit union.
No, no, no. Fair Isaac Corp is not a credit union. This is where your FICO score is, right? So basically, earlier there was some news around that administration, will look at saying use other scores as well. There is another score called Vantage scores, and let's say if the mortgage companies, the lenders start to use other scores, that will basically diminish the importance of FICO. But FICO over past many years, oh, I'm not sharing my screen. Sorry, have had a grip on this whole credit score industry as such, right? So if that's getting disrupted, that may be case. There were another news around, a lot of these new, I would say new lenders, the tech savvy lenders, they don't even look at the scores. They basically will look at your transaction history, look at what are assets and all that, and make their own decisions. That means there is a less need for FICO scores. So there have been some tailwinds that I'm aware of, but I don't know what happened this week. It's down like 21 percent in this week. What, anyone knows FICO? Does anyone own FICO? So that's the biggest one. But yeah, we'll go back and look at, let's say, last 3 years. It's back to where it used to trade in 2022, right? Just close to start of 2023. So gave up all plus 2 years of sorry, this is the end of 2023. Yeah, so almost back where it was like 2 years ago. FICO is another one. Centene, Ulta Beauty. I think Ulta had a results out, and if anyone's interested, we can go through the Ulta results later on. Paramount, Campbell, Axon Enterprises. Axon is a company that I followed for now many years. I don't think I ever took a position. I played options on it. I sold puts and the put spreads on Axon, but never been able to pull a plug in terms of taking a huge making it a part of a regular portfolio because of old margin story. But if Axon is now, maybe if it's the valuation is a little better than what it might look a little attractive. It's also is back to, it's gave up almost 18 months of gains. It was back to where it was in your 2024. That's okay. Sorry, my kid just came and gave me the update. So yeah. Well, looking at Axon's profile, I think I am still not pulling the plug on it. It's got a moat. It's got a decent revenue growth, but I'm still not convinced on its margins and how can it be a great business to own. And I understand the tailwinds behind it, but this has always been a stock that has intrigued me. I followed this for now. It is my fourth year, 2022, I guess, was it 2021 that I started following this stock. Never have been able to convince myself to own a position. That's not to say I first started trading and it was around 200, 300, right? So I can look back and say, maybe when I did, it's already double, but sure. I don't know. Anyone of you own Exxon? I know, Fred, you had it. And you've been a I would say, a bull on Exxon. And we talked about it. Well, I've never been able to take a position on it. And I don't think would like to own a position right now. Anyone own Exxon? No? All right, what else? Any other company that I don't look at? General Mills, Equifax. I don't know what Charles Riddle CoStar is, a real estate data company, I guess. McCormick, Spice, Dollar General, Copart, DoorDash, Cognizant.
Two, it might be a little bit buggy.
Sorry?
Sorry about that.
Oh, okay. All right, what else do you have? Okay, look at the top performers. Familiar names. These names have been like, depending on what the mood of the market is. And, we've seen huge movements in the SanDisk, Micron, Western Digital, Seagate. Right? Three of them are all related to storage. Micron is high bandwidth memory. All are AI driven stocks. Mosaic company. I never owned Mosaic. I don't think I ever even asked about Mosaic. MOS. What is that? Anyone own Mosaic? What does this company even do? Produces and market concentrated phosphate and potash crop nutrients. Oh, this is all like fertilizer stuff. So fertilizer companies have started to prop up as, big movers. But this is it's a $9 billion market cap, $12 billion revenue company. Now let's quickly look at the financials. It's the same as what we saw the other company earlier where they talk about financials. So I think all driven by what's happening in Iran. Then we got a comfort systems, which is for, I think, ACs, coolers. Now all these data centers will need it. Akamai, Lam Research, KLAC, these are all chips companies. Arthur Daniels, again, this is a commodity trading company, wheat and all other stuff. Yeah. Any specific, you're interested in any specific company to look at? But these are like some of the top movers on S&P 500. All right. Another interesting chart from Carson, and this didn't age well. I think they posted it on 12th of March saying, looking at an average of past 20 years, right? This is where the market generally bottoms, the stock generally bottoms around March 12th. Basically, this tells you what's your return, year-to-date return for every day. And you look at that average year-to-date return for last 20 years, you come up with this chart, right? And the question was, hey, has the market bottomed? Because on an average, March 12th is around the bottom. Again, we don't know. Average is just this year may not be an average year. We have a lot of stuff that is different from this year, but this didn't really age well because on 13th the market was again down. So it's not that on 12th we bottom. We never know where it's gonna be. Other news I saw was Oracle and OpenAI. Basically they scrapped their Stargate project, not the project, but one of the data center that they were building in Texas. So now I think Nvidia got involved in it. Nvidia paid $150 million to the developer and got Meta involved in it. So now the same facility would be used by Meta and they will use Nvidia chips. So basically, Nvidia wanted to block AMD from getting into this deal, and then they thought, we're gonna pay $150 million to the developer, and if it's not OpenAI, maybe we'll find another company that will become a tenant for the data center. Now the concern which why the OpenAI and Oracle deal fell through was around OpenAI said we want the latest Rubin chips. And whereas as per the plan, they were the Oracle and the developer, they were building based on Blackwell. Now that causes me little concerns around. It means there's a lot of a change that need to happen in the data centers if you have to switch from Blackwell to Vera Rubin, and that would have added a lot more cost um, for Oracle to build the data center now for specifications for Vera Rubin. And then they said, you know what, okay, we're not going ahead with you. So if there were, so the any of those revenue, that some part of the revenue that Oracle had in their remaining performance obligations coming from OpenAI probably is not going to get it, because they're not going to work together on this one. But right. uh and what else I saw? Oracle actually reported results this week, and let me just quickly look at the results. Oracle. Yeah, so I'm looking at Oracle results. Revenue was what? Let's just build Oracle. Any Oracle shareholders here? So revenue was up like $17 billion, up 22% year over year. It's beat the consensus whisper number. EPS was like non-GAAP EPS was 1.79. Again, that beat the consensus. So beat on top line, beat on bottom line. RPO had surged to $553 billion. But again, those are the so this RPOs may not actually result in a revenue. Like we saw that deal with OpenAI got scrapped, but that was up like 300% year over year. But the low light of its earnings was the debt that they have issued. They issued another $43 billion of a new debt, which is what market is a little concerned about. So now from being a growth story, Oracle has now turned out to be a margin story and your debt story, right? Whether you will be able to service your debt, how it's going to impact your cash flow and all that stuff. So rather than rewarding, and this is not just with Oracle, I think market sentiment has switched. Rather than rewarding all these capex, which they used to do in 2025 and in 2026, market has turned around and say, show me the money, baby, show me the money. If you're spending all this money, if you're funding it through your own cash flow, so there'll not be any dollars left for your dividend or share repurchases, right? Or if you're not using your cash flow, then you're taking on a lot more debt. So that changes the profile of your company and all that stuff. So I think that's a concern that market had with Oracle. They have no, they didn't buy any stocks this week. What have they just declared that dividend that they had? They've been giving what, 50 cents dividend per share, etc. Well, that's on Oracle. Look at the how the stock had performed, and I know everyone, this was a huge jump of almost 30% on Oracle last year, and now we're back to, we are much lower than this. We are back to where we were in, yeah, almost a year. Gave up all the year worth of gains. Looks tempting sometimes that if all this AI story gonna be true, and not that long ago the stock was close to $350. Now it's been cut down in half, right? So I don't know, anyone interested in Oracle? What do you think? If you're already a shareholder, what are you doing with it? Any thoughts?
We we used to have it for a long time, right? And I think, like I said, in that last quarter, it jumped up a lot based on the OpenAI announcement. And then obviously, a lot of companies after that got concerned with how much is dependent on OpenAI and can they, I think they were, I keep hearing like 1 trillion, 1.5 trillion commitments, and the question is, can they really do that, right? Which is why Oracle got hit. And to your point, even now, um, it's all related to that, right? How much are they going to be able to get? Whether their debt, I think, has gone up. The risk on their debt has gone up. All of that. So we're kind of staying out of it, even though it jumped up a bit.
Yeah, I mean, it's to me looks risky. So I did tweet. I think that's went on September when the results came out. Uh, now I'm gonna go back and look at it. This is where I did tweet about it on September 10. Oracle was up 40% after earnings, which is what we looked at. This 40% jump after earnings. It was all because of the RPO, which was up to $455 billion, which is almost 5x of the previous year. But only 12 billion is deferred revenue. Everything else is backlog. Means it's not been, they may not get confirmed into revenue. So guys, too much jump too soon. Think about it. So I guess market has figured it out. That's not all the, this is different between your committed revenue, your deferred revenue, and remaining performance obligations. I think RPO is not a confirmed revenue that is going to come out in future, right? Every contract has a clause in which you could back that out. So we don't know how much of that RPO would actually get converted into revenue. Other stuff, since James says Oracle is a scam, keep away financial engineering. I don't know. I won't term it as scam, but yeah, financial engineering, a lot of companies do. But James, what do you think is the financial engineering? What did you find in Oracle statements that cause you label them as that they are financial engineering their books? Any thoughts? I'm looking at its financials. It's not a hugely growing company. Annual basis, it's like a single-digit revenue growth. But as long as you can still, manage your expenses well and still increase your EPS, etc., you could still do good. Look, profit margins are not that bad. Granted, it's no longer, prior to this AI tailwind, it was no longer a growth company. It became into a mature company to eventually dying company. But because of this AI tailwind and then cloud, especially before AI, it was the Oracle cloud, and they got some big customers like Zoom and all that. Yeah, it did start to turn itself around. Now, whether 40% jump or the valuation at that point was that justified? Probably not. But I'm not sure around the scam or the financial engineering. I shouldn't say I've never owned Oracle. I owned it when it was around $40. And that was, I had an account with Robinhood. And then I wanted to clean up my account with Robinhood because I just wanted to keep everything either on Tastyworks or Think or something. Then I sold that around maybe $80 or something. And then later on, you see that the stock has gone to $300. But beyond that, I've never dug deeper into Oracle. I don't know. They do employ very sometimes a questionable sales practices to continue build their customers or make use of regulatory threats around licensing to scare competition away. But that's very different from being a scam company, I guess. But what does smell like a scam is a tweet which from George Noble, and I do want to read this in full in order, again to see how some of these big company, in this case is basically the Nasdaq exchange, how are they ready to manipulate the index for their own gains and not for the investors or those millions of indirect investors, those who have their pensions, etc., or those who just buy ETFs. So allow me 5 minutes to go through this. This is a pretty interesting and very scathing comment on what Nasdaq is trying to do, right? This is the most shameless structural manipulation of a major index I've seen. SpaceX is preparing what could be the largest IPO in history. We all are aware of that, right? Target valuation is around more than $1.5 trillion. That would make it sixth largest company in America on day one. And Nasdaq wants the listing so badly that they are literally changing the rules on how Nasdaq 100 works. So this is all QQQ, guys, right? And I have exposure to QQQ. In February, Nasdaq published a consultation proposing sweeping changes to how companies enter the index. The timing is pure coincidence, of course. Just like it's pure coincidence that SpaceX has reportedly made fast index inclusion a condition of listing on Nasdaq. So basically, Elon Musk has said, get SpaceX into your Nasdaq 100 index. Only then I will allow to get it listed on Nasdaq. And the exchanges earn a lot of a fat fee from a listing side, right? So Nasdaq changed their rules. A new fast entry rule would let any newly listed company whose market cap ranks in the top 40 of current Nasdaq 100 members to get added to the index just after 15 trading days. Not much of a history. No seasoning period. No liquidity requirement. Completely exempt from the standards every other company had to meet. Currently, new public companies typically wait up to a year before they're eligible for major index inclusion. The waiting period exists for a reason. It lets market establish real price discovery. It protects passive investors from being forced into untested illiquid stocks. And Nasdaq want to throw all of that out for one listing. But the fast entry rule isn't the worst part. The real scandal is 5x multiplier. Right now, S&P 500 uses a free float adjustment methodology. That means, and I had to read this twice to understand it. If only 5% of the company is available for public trading and rest is held by insiders, the index will weigh you at 5% of the total market cap. Makes sense, right? If you're a $1 trillion company, but tradable volume is only $50 billion, then your weightage in the index should be as per the $50 billion tradable. That's a common sense. You weight the company based on what investors can actually buy. Nasdaq current methodology uses a total market cap rather than the free float for weighting. But for the very low float stocks, they at least had 10% minimum float threshold. Under the new proposal, the threshold disappears completely. So no more 10% minimum float. So SpaceX, if they float only 5%, right, they will still be included into the Nasdaq. Instead, any stock with less than 20% free float get weighted 5 times its actual float, capped at 100%. Now do the math on SpaceX. $1.75 trillion, float 5% of the shares. That would be roughly $87.5 billion available for public trading. Nasdaq proposed 5x multiplier. The index will weight at 5% multiplied by 5, 25% of its total market cap. That means the passive funds will be forced to buy as if SpaceX was $437 billion company. Even though the shares available for trading is around $87.5 billion. and only $87.5 billion shares exist. You're forcing hundreds of billion-dollar passive buying into $87.5 billion float. QQQ alone manages $400 billion. Total Nasdaq 100 ecosystem represents $1.4 trillion in exposures across ETF, mutual fund, structured note, derivatives, so on and so forth. Even individual me buying QQQ. Every single passive vehicle tracking the index will be required to buy SpaceX at whatever price market dictates, and we don't even know because only 15 days. On day 15, zero price discovery, zero track record as a public company, and float is so thin that you can read through it. So what this actually does is create a structural wealth transfer mechanism. The passive bid pushes the stock price higher. Higher prices benefit the insiders and the early investors who will still own 95% of the shares. So when the lockup period expires 90 to 180 days later, they will artificially sell the inflated passive bid. Your 401k is an exit liquidity. This is the fundamental corruption of indexing. Indexing used to be brilliant, low cost, efficient. You were free riding on the price discovery done by active managers. So when people say active managers have no role, they do have a role in terms of price discovery. That in the index reflected the market. Now index is the market. Trillions of dollars are flowing blindly into whatever index tell them to buy. People who control the index methodology are changing the rules to serve the interest of IPO candidate, not of market investors. The S&P 500 requires company to have at least 50% of the shares available for public trading. It requires 6 to 12 months of seasoning. Remember, Tesla took many years to get into S&P 500. It uses free float adjusted weighting so that passive investors aren't buying phantom liquidity. Nasdaq is doing just opposite. 15 days, no float requirement, 5x multiplier on insider held shares. Every passive investor in QQQ, QQQM, every fund benchmarks to Nasdaq 100 should understand what's about to happen. The rules are being rewritten to benefit IPO issuers and early stage insiders, and your capital is being used to enrich them. 45 years in business, and I've watched Wall Street find creative ways to separate retail investors from their money in every cycle. But usually, they at least try to be subtle about it. This one, they put it in a PDF and call it consultation. What's your take? That was mind blowing. If everything is true, and this got a lot of attention on Twitter, but some of these things around the Wall Street shenanigans are, I don't know what's the word I can use for this, right? So I've always skeptical around we should get retail investors access to private companies. You saw Robinhood came up with their venture fund. Have anyone, how many of you are excited about Robinhood's venture fund? They recently had released it, right?
The thing with it is it sort of goes back to what you were talking earlier, right? Where BlackRock and others are on the private credit side saying, oh, we can include it in 401ks and things, and use that as a mechanism again to move funds from the early investors, right, to the passive ones. And this is also effectively doing that. And my concern with the private, the Robinhood ones and all is the same thing, right? Generally, the private ones have tended to be ones where you've got people who have experience who can, ride it out for a long time. Your index folks and things, maybe a lot of people who cannot afford huge dips, right? And this is basically going to transfer a big portion of that risk where you'd have much more dips and things to retail ones, and especially the quote mom and pops, right, who are doing through their 401k or whatever. And what you just read is very, very concerning, right? Is sounds like S&P may not be going that route. So maybe as it is, Nasdaq is already heavily in like 5 or 7 stocks represent, I forget, 30-40% of their valuation, right? So this would just make it worse.
Yeah, it'll become way more concentrated. But changing these rules just to satisfy and get the fat listing fee is egregious. Now, talking about the Robinhood stuff, and I know Robinhood, it was maybe last week, this week, I think it was the last week where they have launched their Robinhood Ventures Fund, right? And now, as a retail, the whole pitch from Robinhood was again, retail investors should have exposure to this. This is the greatest thing after the sliced bread or whatnot, right? We have been kept away from private companies and pre-IPO companies, and I understand companies are taking a lot more time to come IPO. So rather, we should be fixing that issue rather than trying to get retail investors into private or pre-IPO companies where you don't have access to the financials. You don't know what those companies are doing. We also don't know in terms of the valuations could be way, way higher than what they actually deserve, right? But nobody wants to talk about that. But Robinhood came up with their own venture fund called Robinhood Ventures, a closed-end fund. And but again, I've not gone through the details of it, but I did hear about a couple of things. One is they got some 4% entry load, right? So when you want to buy it, you lose 4% immediately. And then they got a 2% management fee. This is like a legalized highway robbery. Freaking 4% entry load and 2% fee. And what do you have? You don't even like, of course, okay, data breaks, got it. You don't have a Stripe in it. You don't have a SpaceX in it. You don't have an OpenAI in it. The company that you get exposure to are these companies. ARKK has done similar stuff. They have had a venture. Now they create an ETF out of that. Again, there'll be some funds, my request to all of you who are getting excited by all this, getting exposure to, oh, now I can get exposure to a private company, sounds really sexy, but make sure it gels with your portfolio. We do not have enough information around what these companies' books look like. There's a lot of risk involved in it. Financial services company, be it Robinhood, be it ARK Invest, be it any other Wall Street firm, we will try to peddle these instruments to you because they make fat fee out of it. If it was just an ETF, right? They are getting their lunch eaten alive by the vanguards and the low cost ETFs, right? Now you can get exposure to S&P 500 at 0.03% or 0.02% if you get SPYM. Here, Robinhood is making 4% entry load plus 2% every year, right? So there's huge difference between 0.03% and 2%. Make sure you like the companies in it. Make sure you understand their business before you jump into any of these venture funds. These will be marketed heavily to retail investors because they make a lot of fat fee for the issuers of this company. And I'm not sure if they make any good for the buyers of these. So be careful if you are planning to get exposure to any of these private end of venture funding companies.
One comment I would add, the thing is, you hear about a few of these companies, right? OpenAI or this whatever X company, founders are billionaires, teenage billionaires, da 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 da, whatever, right? The thing you have to remember is that probably 99% of the startups are failing. You don't hear about them. You hear about the 1% that's succeeding, and you have no idea with any of these if you're really getting the ones that are going to succeed, or if you're going, getting into those, how late are you getting into it, right? Are they already way up and you're just getting into the tail end? So that's one of the things to really be careful about with any of that private stuff, right? So just a comment.
Yeah, no, no, you're absolutely right. We could just be an exit liquidity for the VC firms, right? And and this will also tells sometimes could be a signal of, hey, there's a lot of fraud coming in the market. I mean, my CPA is starting a lot of these SPVs, and I'll get mail every other week around, hey, we are opening it up for investment in OpenAI. Now we are opening it up for investment into XYZ other companies, right? Anthropic, SpaceX. and you have no idea what the valuation is. Sometimes these SPVs are special purpose vehicles which get exposure to these companies. They are layered with fees. SPVs, some of the SPVs, they'll charge you money, and they probably end up investing in that ARKK ETF, or let's say Robinhood Venture Fund, then which also charge money. All as a retail investor, you end up paying is a huge fat sum of money, even though let's say the stock appreciate, you and might end up just losing money. So it's such a horrible way to invest. And I understand why these companies are doing it, because the number of companies coming to public market has been declining. We have almost 1/3 of the companies that now trade in public market, whereas the companies that stay in private market have increased, and the companies are taking much longer time to become public if at all they want to. So a lot of wealth is being created in a private space. I don't doubt that. The question is trying to play with these may not be the best instruments to play with this, because these are saddled with high fee. The the right way to do this will be to make sure that we make the process of going to IPO cheaper, faster, and less, I would say, headache for this public, for the companies. Why the companies have stopped going to IPO sooner, or wait until they become much bigger? Because there's the cost of being a public company has increased multifold over decades. The cost, because now once you're a public company, there is a lot more scrutiny on it. You're a lot more exposed towards lawsuits. You got a quarterly reports that you have to come and announce. There's a lot of a cost involved in just being a public company. Right way, if the regulators want to solve this, is not to allow retail investors into the private companies, but maybe change the regulations so that the private companies can become public and stay public at much lower cost. That would be the right way to look at it. But I don't know this. So again, if you want to invest in this, just understand the cost that you're paying and which companies you're getting. And want to take a blind bet? Sure. Just don't put your food money on it. That's all I want to say. You never know what pricing are you getting these companies at. And then whether the company go up or down, the fee is like a theta decay happening on your fund, on your investment is a 2% fee. That's just, they're just gonna take it out year after year.
Is there any startup which basically try to disrupt this IPO market?
So because these IPOs are regulated, right? I don't know, because it's not that the there are startups in disruption. It means, hey, if you can't get IPO, we'll give you another way to get a liquidity. But it's all for those who are early owners and investors on it. There are startups that have created secondary market shares. Sorry, secondary share markets, right? Hey, you can't go IPO, but your employees are stuck with the company now for 10 years. They haven't had any liquidity. We will disrupt that. But because the IPO process is so regulated one, unless the regulations change, there's nothing much that on a tech side you can solve anything. You can only work around that, which is what many startups have trying to solve the problems for early employees and early investors to provide them liquidity in absence of IPO. That I've seen. I mean, you can buy um, your you can buy, let's say, some of these companies on secondary shares market, and they may not IPO for many years. I know some of my friend who bought, let's say, Rubrik and maybe Sentinel One in secondary share market before they became public. So there are, but those are the solutions for the early employees, how they get a exit liquidity.
Vivek,
Yeah.
did those not employees that bought it in the secondary market earn significant
No, no,
valuations?
those are the employees who sold in the secondary market,
Okay,
and people like you and I bought.
okay,
Yeah, yeah. So if you want to buy it because the company is not coming IPO, if you want to get an exposure to this, the secondary market shares are there. But now these like Robinhood Ventures is doing the similar stuff. Instead of you individually getting an exposure, because some of these markets have a like equities then used to be one. I think equities then got bought over by Force Global. Then there are a few companies. I forgot the name of another one. It's a very they keep sending emails. I can't recall. So there are a few companies in which create your account, minimum $25,000 investment, or depending on a company, you'll have a minimum cap, $10,000 investment. You can go and see Hive. Yes, thank you, Pranav. Hive has been recently in the news. I mean, like 4 or 5 years ago, I knew equities and Force Global. Hive is now seeing a lot more news around Hive. They do similar stuff. You can buy and get a shares if any employees are willing to sell their shares. You can buy in these markets. But again, you never know. You have not. We have seen many such companies that were valued heavily in the private markets. Once you come into the public market scrutiny, markets are like, what the heck? Is the business I'm going to pay for it? Look at the prime example would be look at WeWork. In a private valuation, they were valued at almost $40 billion. When they came under public scrutiny, the same uh, investment bankers who did the deal at $40 billion were not even able to put their own money at $8 billion. Because once they had to file all the disclosures, they have to share all the financial statements, public market investors puked on WeWork. And then that was like they never did IPO because they realized, come on, the public market is, yeah, they don't do their due diligence. So I've seen many companies that were highly valued during the private cycle, like Rubrik. Rubrik is still a good company. I mean, it's a highly valued, but in a private pre-IPO, the share price was higher than where it is today. Many such companies could be richly valued in a private, but when they come to public, then they basically face the real test. Right? So be careful about it. That's all I want to say. Many of these companies will try to sell you these instruments because they make a lot of money by fee. They are not putting their capital, it's your capital that is at risk. So James, research the funds that your 401k IRA are investing. Yeah, you should know what they are investing in. Any hedging options against SpaceX IPO without exiting private index funds? Once a SpaceX become IPO, and if you think that it is richly valued, I'm sure options will be listed pretty soon on SpaceX. Then you can, take expo, do a negative delta trades on SpaceX. Or if you are brave enough, you could short SpaceX. I won't recommend because market can stay crazy longer than your portfolio can stay solvent. Right? That's it, right? If you are a shorting stock, you have to keep funding your losses until your thesis is proven right. And sometimes it may take way longer. And we saw during the 2020 GME, hedge funds got blown up, even though they were eventually proven right. But they couldn't sustain the losses. So you gotta be careful. It will be interesting to see. What I'm hopeful about is when the SpaceX IPO comes around, hopefully it will improve the sentiments for a lot of other companies around IPO, and we might see a lot more IPOs coming in. But anyway, that's only time will tell. Right. Another interesting stuff that I saw was around DCA. What's DCA? Basic one-on-one question around investing. as a passive investor. What's a DCA? Come on. You do it. Knowingly or maybe unknowingly, all of you are doing it. It's dollar cost averaging, right? But this is, again, most misquoted term. People will say, oh my gosh, my stock has gone down. Maybe I'll dollar cost average into it now. Okay. So just want to throw some things that we do as an investor, but it's just not DCA, right? A stock that you bought has gone down, you buy more. That's not a DCA. This is called averaging down. You're intentionally building your position up to desired maximum position size. I did one trade this, I bought one stock this week. I did many trades, but I bought one stock this week because it's not reached my in position size and the stock is down, but I'm building my position, right? That's not a DCA. That's scaling into position, right? Adding to your winner, right? That's like, it's called pyramiding. Doubling down on your losses. Right? We saw some, I think we talked about a few weeks ago, and I really did not understand what the martingale strategy was, but then one fund blew up because they deployed this strategy called martingale strategy, right? I don't know, buying back when the stock bounces a particular moving average. If you're a chartist, you would want to buy it once it bounces off whatever 200-day moving average. You think it's gonna go up. That's not dollar cost averaging, and so on and so forth. Buying when the stock has just called golden. All of these things we think, oh, I'm averaging into my position. That's none of this is dollar cost averaging. What is dollar cost averaging? What is dollar cost averaging? And what chart do you look when you're trying to dollar cost average into your position? Anyone want to share their thoughts? You can unmute yourself and let's talk about what a dollar cost average is.
You buy it at like monthly, whether it goes up or down.
And there's one more thing. You talked about time. You talked about the price. There's one more thing that is remaining. You put the same amount of a capital every week. Right? So if you're deciding I'm gonna dollar cost average, say I'm putting $1,000, $100, $500 at a specified frequency. It could be every month, could be every week. I'm gonna put $100 every week into this ticker, and I don't care what the price is. That actually is dollar cost averaging. Anytime we are making a decision on, is this price right? Should I, oh my god, the price is too high, maybe I should just invest less. I do, but I'm that's not dollar cost averaging. Or maybe it had gone down, it's been beaten too much, maybe let me add a lot more capital than I would generally do. That's not dollar cost average. So through our 401ks, we dollar cost average, right? We don't know what the price of S&P would be. You get your money deposited in your 401k, you buy, you've already specified in your 401k provider what's the percent of investment that you want to do in every stuff. That's percent based, that's not even dollar cost average. Okay. But the real dollar cost average is you decide the amount so that the prices go higher, you buy the less units of it. Prices go low, you buy the more units of it. That's how you reduce the average price, right? And you buy it at a specified intervals. Don't care where the prices are. Now, if you go back and look at it, are you really dollar cost average investor? Or if we actually making any decision on three things: interval, price, and the amount, then it's not dollar cost average. Call it something else. Right? But I've seen this term abused in terms of anytime the stock fall down and people want to say, I'm going to put capital into it because I want to dollar cost average. No, that's not dollar cost average. It's something else. Would DRIP be DCA? So DRIP would be DCA because you're getting almost the specified amount, unless the company changes the dividend, right? Like Oracle be paying 50 cents, they will be paying 50 cents, whatever. Uh, and some companies, they do increase it, but then they stay same for the next 4 quarter. And you bite every quarter when they give a dividend, and you don't care what the price is. So that I would consider the closest to dollar cost average. But not some of the active decisions we make otherwise. James says if you like the stock at 100, you should love it at 50. Most of the time, people have opposite reaction. Because you like the stock, if you like the stock at 100 because a neighbor bought it, because maybe you heard it on Saturday meetup, but you didn't do your own homework, then you will never love it at 50. You will hate it at 50. that's that's the biggest challenge. And if you really like it, it shows up. If you add more at 50, then we really know, okay, you build your conviction. Sometimes it turned out to be wrong. Well, that's okay. We will always learn, but it's always good to build your own conviction. I think I love saying this. I'll say it again. You can borrow an idea, but you can never borrow a conviction. You can borrow a stock idea, but you can never borrow conviction. And what will get you through the tough times, which each one of your holdings will go through, is the conviction. So if you want to go through the tough times, build the conviction in your holdings that you're holding. And what I've found is only conviction only comes from if you spend time in understanding the company. Doesn't matter, Bill Ackman has said this, or XYZ YouTuber had said this, and I bought it, or Brad Gusner said it, but if I've not spent time in going through the report or earnings or reading through research on it, I've never been able to build conviction in it. You could be different. And when the times are bad or worse, I'll be the first one to chicken out on all the stocks that I bought because I heard about it somewhere. Those are the first one I'll get out of it because I didn't build conviction. And probably the last one before, okay, yeah, which is that this is an interesting chart. And on Twitter, there was a lot of people who were also basically, what the heck these guys are doing. This basically tells us the income group and who's spending on delivery, right? Per person per year, how many transactions are happening. Income group less than 50K actually order from DoorDash almost 12 times per year. And if you ever looked at your DoorDash receipt, you will know how expensive it is as compared to you calling the restaurant directly and maybe picking from there. And sometimes I found it is like the overhead cost is 50% more than what the restaurant's listed price is. If you look at a DoorDash, the pricing will be different than if you look at the restaurant menu directly. Then on top of it, DoorDash will add its own fee. Then on top of it, the delivery fee. Then on top of it, you'll also tip the dasher. Eventually, if a dish costs $10 for you to go and eat in the restaurant, you might end up paying $15 to get delivered to your house. So the thought would be, hey, only expense, the rich people would be able to afford. Surprisingly, the income group 30 to 50K orders the most. And they also spend most on delivery. This is the delivery spending per person, not that they order the most number of times. The average order, the average of the total order per year is the highest among less than 50K. And obviously, if your dollar value is higher, and since you're only making 50K, the amount of the percent is also higher, right? This is just math. So whereas a higher income group spend, because they spend less dollar, they spend less percent. Uh, that was the interesting one. So there was a lot of negative sentiments around these people don't know what they're doing or why they're spending so much and all that stuff. There could be a few reasons, and I'm not against and saying they shouldn't be doing it, because maybe if I were in their shoes, I could have done the similar stuff. There is a question around how does that track against the age, right? It could be just an age concern also. Maybe the people in 30 to 50K are all college those who are studying in college. Right? That may be one reason, hey, a lot of kids will do dash. But I think studying in college and making 30 to 50K on average probably out of bounds. But what could another reason be is, and I got inspired by the similar stuff you see in the lottery tickets also. The biggest spenders on the lottery tickets in US, and lottery is a big business. You spend more money in lotteries than in sports, book, and music combined. But the biggest spenders on the lottery tickets are the people who could least afford. They come from the lowest strata of income ranges. But there's a lot of psychological reason behind it. And I don't know, maybe that's a reason that's also playing out in this. Because you are in an income group of less than 50K, maybe this is the only luxury that you can afford. You cannot go out on expensive vacations. You may not be able to buy the latest Xbox. You may not be able to buy the best dress, new prom dress. You cannot spend $200 on a prom dress, but maybe you can treat yourself with a DoorDash. Again, that's why I don't just want to be negative on this group, because I've not been in their shoes. There could be a reason why they're doing it. Some could be just a dumb reason because, come on, I've not been managing my finances. That could be a part of it, but that may not be the only part of it. But I just wanted to share that with you. Like, I thought it exists only in the lotteries, whereas the lowest income, and especially it's also more prevalent into African Americans, they spend a lot more on lottery at the lower age income. Whereas if you look at it from a prudent financial manager perspective, they shouldn't be spending anything on lottery. We know most of people lose money in lottery. But it's more psychological that $2 lottery has some chance to change their fortune, whereas the rest of their financial life is anyway messed up. So anyway, so I saw this, thought maybe I will share this. There are some behavioral aspects of how we spend money that you cannot put in some scientific formula, or you cannot always think through that. They are not always governed by the prudent financial management principles. Okay. All right, so what did I stocks buy or sell this week? I added a little more to my Mercado Libre position. This is what the scaling is. It has not yet reached my full position. So I added a little bit more, but I'm not dollar cost averaging it. Let me put it very. This actually hit 200 week moving average. I'm not I generally don't look at too many charts, but I did really, I do have this 200 week moving average. The real reason was I have a short, I had an iron condor on Mercado Libre. My short put spread is completely now deep in the money. So I'm like, okay, let me buy some shares and take a loss on the option side. That was a reason, not that it hit. It is just a coincidence that it also hit 200 week moving average, right? But that's why I bought a little Mercado Libre. Same case on INDA, India ETF. My put spread is in the money, so I bought some shares. So if you look at both Melly and INDA, right? Oh, come on. Right. So Melly has been like back to where it was right here, I would say. Right, which is almost 2 years. whereas the revenue has grown. And I understand why the market is a little concerned. The recent dip was because of their increased investment in Argentina. Every time market dipping, it's because they are increasing their investments either in launching new products or in logistics side. Right? But I'm okay with that. Um, market thinks their lunch is being not they're being basically pressurized into making these investments because of competition coming from other companies like C Limited. They're expanding big in Brazil. Amazon is making some investments in Amazon Bazaar, mostly at an high end side. But sure, I own C Limited and Amazon as well, so that's okay. But I think this is again, I'm still bullish about the company. This is the only public company I know of that have reported greater than 30% growth in revenue for 29 consecutive quarters. It almost more than 7 years of consecutive, every quarter growing more than 30%. Okay. And there's a lot of opportunity on LATAM side. Of course, there's a lot of competition that I'm aware of, but hey, as long as you keep your position size limited, should be okay. So it hasn't reached my positions full position size yet, so I bought it. Okay. India again want to have an exposure outside of US, so that wasn't what did I sell? Nothing. Didn't sell, no stock selling this week. Right. This is a for me personally, this would be a time to buy if I'm more capital coming in. All the capital that I've used is through my option income, just flowing it back into buying the stocks and of course to pay bills. But that's for the bias today. Any stocks that you guys bought this week? I'm seeing some comments. Many reasons: time, poverty, ultra low, thin, fraction on DoorDash, check out urban patterns, behavioral economics. Yeah, and that sometimes also has to do with the demographics. Right? I I know my kids don't even think twice before ordering on DoorDash. Right? I cannot do that. I'm like, why would I pay like 50%? And it's a different how you value your time, right? So I'll spend 5 minutes and go and pick that order from restaurant myself, right? Take the car out, it's not too far away. Whereas I'm sure my kid will just order it on DoorDash. Sachin says maybe they're getting reimbursed by employer for DoorDash, but looking at a 30 to 50K brackets, uh, uh, I'm a little doubtful in terms of the employers who offer these perks. They generally offer it to those employees who are in demand, right? You can't find those employees, either you have a dearth of those employees, but then you won't be paying them 30 to 50K. Ramesh is saying switch from Melly to SanDisk ASML KLAC, recovered losses from ASML. Uh, come on, ASML, I mean, it's been trading high, so maybe losses you might have had either you bought it early or you had a put spread, which is now in the money loss. But ASML has been a great addition to the portfolio of past many years. Pranav bought Visa. Visa is a company that it's a pretty stable, huge network moat. Visa, MasterCard are two companies that I've seen in almost every value investor's portfolio. Right? There were other companies that are now getting challenged. Your S&P Global, your and Moody's, those are again challenged, but Visa and MasterCard is like a staple on every value investor. They have a consistent internet fee coming in, a huge network moats, etc. See Zim message above. Oh, okay. I don't know maybe which one I missed. How do you determine max position size? It's I call it as a sleep number, right? Not the mattress sleep number, but what will not cause me to lose sleep over it, right? So I look at my positions in two ways, and that's just me. One is what part of my, what the current value of that holding, what percentage is that of my overall portfolio value. This is a number that I report every month, right? When I share my portfolio, you look at, okay, now Google is 6%, right? It's the overall 6% of a value of my portfolio, right? The other way I look at it, which is where I'm saying Mercado Libre has not reached my position sizes, I look at it, what's its cost basis is against my overall portfolio. Let's say if I spend $100 in building a portfolio, how much did I spend it on Mercado Libre? So that's what I want to focus on, and I'm looking at it. It hasn't yet reached, the what I'm comfortable in terms of spending into a particular company. So that you can determine what your sleep number could be. You might be okay of putting out of $100 if you're okay and you can sleep well by putting $50 into one company. Sure, go ahead. I'm no one to tell don't do it. For me, it would be a very risky proposition. I'll be losing sleep over it. For me, it could be max 10%. Now, if that position that I built in by putting $10, that could grow to $15, $20. That's a different, that's get reflected into what your current value is. Right? But I don't think I would want to put more than maybe 10% of my overall cost in, let's say, Mercado Libre. And it could be different for different companies. And it hasn't reached that there yet. So that's why I still scaled into the position. Hope that helps. There is, and I am firm believer that there is no single number which will be right for everyone. It depends on what kind of investor you are, what your makeup is. There are some investors who are very concentrated investors. They're like, if you have built conviction on it, why don't you start with big position? And sometimes I come and talk about it that, hey, I'm initiating a new stock. I think it's a good one. I'm building conviction in it, and I'm gonna put 0.25% to start with. And then some people look at me and say, you're not having a huge conviction. No, my style of building position is different. I'm not gonna start with 4% or 5% allocation as my first trade. I always will do less than 1%. Then read about the company more. And when I get comfortable, it will be a years before it reaches my full position. That's just who I am. Right? Conviction and concentration are two different things. I wanted to cover this next week, but since we talked about it, let me put it that way. Position could become bigger. That's okay. But I'm not gonna, my first trade is, I don't think any time I bought a first trade which is more than 1 or 2% of my portfolio as my first trade. I always scale into it. Always want to give market to prove to me, the stock to prove to me that it is worthy of portfolio. Anyway, there are, yeah, we did hit our mark. So there are some earnings if you're interested. Maybe I can go through them. I have data collected for these. Otherwise, I'll open the breakout rooms anyway. We're gonna talk about other stuff on a different variety of topics. You can do that in those breakout rooms. Okay, let me stop sharing. Let me stop recording.